Digital currency and its impact on traditional banking. Introduction. Digital currencies, including cryptocurrencies like Bitcoin and central bank digital currencies, have introduced new dimensions to the financial landscape. These innovative forms of money promise to revolutionize how individuals, businesses, and governments handle financial transactions. While digital currencies have gained significant attention for their potential to disrupt traditional financial systems, their impact on traditional banking is still evolving. This article will examine the rise of digital currencies, their implications for traditional banking, and the challenges and opportunities they present for financial institutions, regulators, and consumers. Number 1. Understanding digital currencies. Digital currencies refer to forms of money that are stored and transacted electronically. Unlike traditional currencies, which are issued by central banks and have physical forms like coins and banknotes, digital currencies exist only in digital form. These include cryptocurrencies, which are decentralized and operate on blockchain technology, and central bank digital currencies, which are government-issued digital equivalents of national currencies. This section will explore the fundamentals of digital currencies, explaining the differences between cryptocurrencies and CBDCs and their respective roles in the financial ecosystem. Number 2. The rise of cryptocurrencies. Cryptocurrencies such as Bitcoin, Ethereum, and many others have emerged as decentralized digital assets that operate outside traditional banking systems. These digital currencies leverage blockchain technology to enable secure and transparent transactions without the need for intermediates like banks. Cryptocurrencies have attracted attention for their potential to bypass government control, offer financial inclusion to the unbanked, and provide an alternative store of value. This section will delve into the rise of cryptocurrencies, their key features, and the factors driving their adoption across the world. Number 3. The emergence of central bank digital currencies. In response to the rise of cryptocurrencies, many central banks are exploring the development of their own digital currencies, known as central bank digital currencies, CBDCs. Unlike cryptocurrencies, which are decentralized, CBDCs are issued and regulated by national governments, maintaining the same stability and trust associated with traditional fiat currencies. Countries such as China, the European Union, and the United States are exploring the potential of CBDCs to modernize payment systems, enhance financial inclusion, and improve monetary policy implementation. This section will discuss the concept of CBDCs, the ongoing pilot projects, and the potential advantages and challenges associated with these state-backed digital currencies. Number 4. How digital currencies work. Blockchain technology. At the core of most digital currencies, particularly cryptocurrencies, is blockchain technology. A blockchain is a decentralized distributed ledger that records transactions across multiple computers in a way that ensures transparency and security. This technology eliminates the need for centralized intermediaries like banks and offers a tamper-proof system for verifying and recording transactions. This section will provide an overview of how blockchain technology works, its role in facilitating digital currencies, and its potential to disrupt traditional financial systems. Number 5. The advantages of digital currencies. Digital currencies offer several advantages over traditional banking and fiat money systems. They can enable faster, cheaper, and more secure transactions, particularly in cross-border payments, which are often subject to high fees and delays. Additionally, digital currencies can promote financial inclusion by providing unbanked populations with access to financial services. Furthermore, the transparency and immutability of blockchain technology can reduce the risk of fraud and corruption. This section will explore the benefits of digital currencies, highlighting their potential to transform payment systems, improve financial access, and enhance efficiency in the global economy. Number 6. The challenges of digital currencies. While digital currencies present significant opportunities, they also face numerous challenges. These include regulatory uncertainties, volatility, security risks, and concerns about money laundering and illicit activities. Cryptocurrencies, in particular, have been criticized for their association with illegal transactions and their potential to destabilize traditional financial markets. Furthermore, the lack of widespread understanding and trust in digital currencies has been a barrier to adoption. This section will examine the key challenges associated with digital currencies, particularly cryptocurrencies, and the potential risks they pose to financial stability. Number 7. Impact on traditional banking, disintermediation. One of the most significant impacts of digital currencies on traditional banking is the potential for disintermediation. Disintermediation refers to the process by which intermediaries, such as banks, are bypassed in financial transactions. Cryptocurrencies, with their decentralized nature, enable peer-to-peer transactions without the need for a bank or other financial institution to facilitate the exchange. This could lead to reduced demand for traditional banking services, particularly in areas like payments, money transfers, and currency exchange. This section will explore the concept of disintermediation and how digital currencies could disrupt the role of traditional banks in the financial ecosystem. Number 8. Changing the payment landscape. Digital currencies are revolutionizing the payments industry, offering alternatives to traditional payment systems like credit cards, bank transfers, and payment processors. With the ability to facilitate instant, low-cost transactions globally, digital currencies are making cross-border payments easier and more affordable. In addition, CBDCs could enhance the efficiency and speed of domestic payment systems. This section will examine how digital currencies are changing the landscape of payments, including their potential to replace or complement existing payment infrastructure. Number 9. Regulatory responses to digital currencies. Governments and financial regulators around the world are grappling with how to regulate digital currencies, particularly cryptocurrencies. The lack of regulation has been a key concern, as it can lead to illegal activities like money laundering and fraud. In response, many governments are introducing or considering regulations that would bring digital currencies under the same regulatory frameworks as traditional financial products. Central banks are also developing frameworks for CBDCs, aiming to balance innovation with financial stability. This section will discuss the regulatory responses to digital currencies, focusing on efforts to ensure consumer protection, financial stability, and compliance with anti-money laundering and know your customer requirements. Number 10. The role of traditional banks in the digital currency ecosystem. While digital currencies could reduce the role of traditional banks in certain areas, they also offer opportunities for banks to innovate and integrate these new technologies into their services. Many banks are exploring blockchain technology for improving back-office operations, enhancing security, and offering new products like digital wallets. Additionally, some banks are beginning to offer cryptocurrency-related services, such as trading and custody solutions. This section will examine how traditional banks are adapting to the rise of digital currencies and how they can leverage blockchain and cryptocurrency technology to maintain their relevance in the evolving financial landscape. Number 11. Financial inclusion and digital currencies. One of the most promising aspects of digital currencies is their potential to promote financial inclusion, particularly in developing countries where access to traditional banking services is limited. Digital currencies can provide an alternative to traditional banking systems, allowing people to send and receive money, store value, and access financial services through smartphones or computers. This section will explore how digital currencies, particularly cryptocurrencies and CBDCs, can enhance financial inclusion and provide banking services to unbanked and underbanked populations worldwide. Number 12. Security and privacy concerns. As digital currencies become more widely used, concerns about security and privacy are becoming more pressing. Cryptocurrencies, while secured by blockchain technology, are still vulnerable to cyber attacks, hacking, and fraud. Additionally, the anonymity of cryptocurrency transactions raises concerns about money laundering, tax evasion, and other illicit activities. CBDCs, on the other hand, may provide greater control over transactions but could also lead to privacy concerns regarding government surveillance of citizens' financial activities. This section will address the security and privacy issues surrounding digital currencies and the measures being taken to address these concerns. Number 13. Potential for new financial products and services. Digital currencies are creating new opportunities for the development of innovative financial products and services. These include decentralized finance applications, which allow users to engage in lending, borrowing, and trading without the need for traditional financial intermediaries. Additionally, the rise of digital currencies may lead to new forms of investment, such as cryptocurrency funds, tokenized assets, and blockchain-based securities. This section will explore the potential for new financial products and services that could emerge as digital currencies continue to evolve and gain adoption. Number 14. Conclusion. The future of digital currency and banking. The rise of digital currencies is poised to have a profound impact on traditional banking, offering both opportunities and challenges. While digital currencies can enhance the efficiency and inclusivity of the global financial system, they also raise concerns about security, regulation, and financial stability. As governments and central banks continue to explore the potential of digital currencies and regulate their use, the future of traditional banking will depend on how well it adapts to these changes. In the coming years, the integration of digital currencies into mainstream finance could lead to a more efficient, accessible, and secure financial system, transforming the way individuals and businesses interact with money. Conclusion. Digital currencies, including both cryptocurrencies and central bank digital currencies, are reshaping the financial landscape in profound ways. Their potential to disrupt traditional banking systems, revolutionize payment processing, and improve financial inclusion cannot be overstated. However, challenges remain, including security risks, regulatory issues, and the need for widespread adoption and trust. As central banks, financial institutions, and regulators continue to adapt to the rise of digital currencies, the future of banking will likely be defined by a new hybrid system that blends the benefits of traditional finance with the innovation of digital currency technology.